Hey there, fellow investors. Welcome back to our channel. In this ever-evolving financial landscape, I've noticed a common theme in the comment section of finance-focused channels on YouTube. Some suggest that certain investments are a no-go due to their expected future returns being less than stellar. But here's the thing. This might be one of the biggest misconceptions in modern finance, and today, we're diving deep into why that is. This is the Finance Virtuoso Channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. In this video, we're tackling a common misconception in finance: the belief that certain investments are bad because their future returns may not be great. Well, I'm here to shed light on this and show you why diversification is the key to successful investing. Now, let's get started. Understanding the roller coaster of investments. It's super important to grasp the simple truth that all investments have their moments of going up and down. We've all heard about market crashes and changes and how stuff like stocks and bonds are worth. But what really matters is realizing how big these ups and downs can be and how consistent they are. When we look at the numbers, it's clear that every type of investment, stocks, bonds, real estate, or even things like commodities, has had its fair share of big drops. Way back during the Great Depression, the Dow Jones Industrial Average fell by nearly 90%. Even long-term US Treasury bonds lost more than half their value between 1941 and 1982. And don't be shocked, but good old cash, shown by Treasury bills, lost almost half its real value between 1933 and 1952. These drops in the past might sound scary, but here's the real deal. Every investment goes through these ups and downs. No matter what kind of investment it is, those drops can be pretty darn big and can stick around for quite some time. Understanding this roller coaster is key. Sometimes, investments seem like they're taking a nosedive, which makes folks think some investments are just plain bad. But hold up. The real secret is having a mix of investments that can handle the wild ride and come out on top. If you're an investor, what really matters is how the whole bunch of investments is doing, not just one. Your goal might be saving up for different stuff, like a safety cushion, buying a house, or cruising into retirement. To make it work, you need a bunch of different investments that can balance each other out, so you're always getting closer to your financial dreams. Modern portfolio theory, a fancy name, I know, says that different types of investments act differently in different situations. So, having a mix of stuff, like stocks going up when bonds are sliding, or the other way around, keeps you away from the scary financial drops during market slumps. How blending different investments can reduce risk. Let me break it down with an example. Imagine you have an all-stock portfolio where all your money is in a US stock market index fund. Now, picture this chart that shows the 15-year rolling returns and risk-adjusted returns for this all-stock portfolio over the past 50 years. On average, this investment has given you strong returns of about 7.6% per year, after adjusting for inflation. But hold up. It's not all sunshine and rainbows. It's also had its rough patches, dropping by as much as 50% and spending nearly a third of its time in a crash zone, which is 20% below its previous all-time high. Now, let's step it up and bring some bonds into the mix. In this next column, we have a 60% stock and 40% bond portfolio. Stocks are still represented by the total stock market index fund, and bonds are represented by long-term US Treasuries. Adding bonds slightly lowers the average 15-year returns, but not by much, just around 1/4 percentage point. Wait a minute, you might wonder. Shouldn't adding bonds bring down the returns more significantly? Well, here's the magic. When you blend investments that behave differently, like stocks and bonds, the way the returns compound changes. And that makes a difference when you regularly balance your portfolio. Now, let's see how stocks and bonds performed individually since the early 2000s, compared to when they're combined in a 60% stock and 40% bond portfolio that gets rebalanced annually. Back in the early 2000s, stocks fell by around 30% due to the dot-com bubble burst. But at the same time, bonds went up by about 24%, softening the blow for the combined portfolio. During the 2008 financial crisis, stocks plummeted, but bonds gained around 24%, once again helping the combined portfolio. Now, let's level it up a notch and add another investment: gold. Gold has been struggling for a while, but it's a hedge against uncertainty. By putting 20% of your money in gold, 40% in stocks, and 40% in bonds, you're creating a more balanced portfolio. While gold hasn't been performing great, this mix raises the 15-year average real return to around 6.6% per year. The amazing part? The floor for your returns increases significantly with a minimum 15-year real return of 5.5% and a solid baseline return of nearly 6% per year. Adding bonds and gold not only improves the consistency of your portfolio, but also lowers the volatility. The mixed portfolio has nearly 30% less volatility compared to an all-stock approach. And don't forget the crucial lesson. Even though an investment might struggle in isolation, it can still play a vital role in your overall strategy. What truly matters is how your entire portfolio performs and whether it gets you where you want to be financially. Having investments that rise while others fall can be a game changer, ensuring that you're not caught in a situation where everything crashes together. In conclusion, we've debunked the investing myth that certain assets are bad to hold due to potential lower future returns. Remember, all investments go through ups and downs, and what truly matters is the overall performance of our portfolio in the long run. Diversification is the key to successful investing. By spreading our investments across different assets like stocks, bonds, and gold, we can reduce risk and achieve more consistent returns. This approach ensures that we're on track to reach our financial goals. So, don't let misconceptions like this hold you back. Embrace a diversified strategy to weather market storms and secure your financial future. Thanks for joining us today. If you found this video helpful, don't forget to like and share this with friends who find value in insightful content on investing and finance. Happy investing, and I'll see you on the next video.